The stock market can seem like a jungle of jargon, a place where the uninitiated can easily get lost. With its complex terminology and ever-changing numbers, it can be overwhelming. It's a confusing whirlwind of numbers and trends that can leave even the most seasoned investors scratching their heads. But don't worry, we're here to cut through the noise and make sense of it all. Think of us as your guides through this dense financial forest. Understanding key stock market terms is crucial. These terms are the building blocks of your financial knowledge. This knowledge empowers you to make informed investment decisions, giving you the confidence to navigate the market with ease. Get ready to unlock the secrets of the market. We'll reveal the hidden gems that can make a big difference in your investment journey. This beginner's guide will break down essential stock market lingo. We'll use simple language and clear examples to ensure you understand. You'll grasp the basics in no time, and soon, you'll be able to read stock charts and understand market trends with confidence. Let's embark on this exciting journey to financial literacy together. By the end of this guide, you'll be well on your way to becoming a savvy investor. First things first, what exactly are stocks? Stocks represent ownership in a company. When you buy a stock, you're essentially buying a piece of that company. Imagine a company like a giant pie. This pie represents the total value of the company. When you buy stock, you're buying a slice of that pie. Each slice represents a portion of the company's value. These slices are also called shares. Owning shares makes you a shareholder. As a shareholder, you have a stake in the company's future. You now have a tiny piece of ownership in that company. This means you share in both the risks and rewards of the business. The more shares you own, the bigger your slice of the pie. A larger slice means a greater share of the company's profits and assets. As a shareholder, you're entitled to a portion of the company's profits. These profits are often distributed as dividends. You also get voting rights on certain company decisions. This includes electing the board of directors and other major corporate actions. It's like having a voice in the direction of your favorite pizza place. You get to help decide what toppings go on the pizza and how it's made. So owning stocks is not just about potential financial gain, but also about having a say in the company's future. It's a way to be part of something bigger. Now let's talk about how your investment can make you money. Companies distribute a portion of their profits to shareholders. These payouts are called dividends. Think of them as little thank you gifts from the company for being an owner. Another way to profit is through stock price appreciation. If a company performs well, demand for its stock increases. This drives up the stock price, increasing the value of your investment. It's like watching your money grow. Section 4, Market Mood Swings, Bulls, Bears, and Volatility. The stock market is like a roller coaster with its ups and downs. Just like a roller coaster, it can be thrilling and terrifying at the same time, with moments of exhilaration followed by sudden drops. When prices are generally rising, it's called a bull market. This is a period of optimism, where investors feel confident and are willing to take risks. Investors are optimistic, buying stocks and pushing prices higher. They believe that the economy is strong and that companies will continue to grow and be profitable. Conversely, a bear market is characterized by falling prices. This is a time of pessimism where investors are worried about the future. Investors are fearful, selling stocks and driving prices down. They may believe that the economy is weakening and that companies will struggle to make profits. It's like the market is hibernating, waiting for better times. During these periods, trading activity can slow down significantly as investors wait for signs of recovery. These market fluctuations are called volatility. Volatility can be caused by various factors, including economic data, political events, and changes in investor sentiment. Understanding these cycles helps you make informed decisions, buying low and selling high. By recognizing the signs of bull and bear markets, you can better navigate the ups and downs of the stock market. Section 5. Portfolio Power, Diversifying Your Investment Strategy. Imagine putting all your eggs in one basket. Risky, right? The same applies to investing. Diversification is key. A portfolio is like your investment basket. It holds all your different investments. Instead of focusing on just one stock, diversify your portfolio. Invest in different companies, industries, and asset classes. This spreads your risk. If one investment performs poorly, others can cushion the blow. Section 6. Conclusion. Your journey to stock market savvy. Congratulations! You've taken the first step towards mastering the stock market. You've learned about stocks, shares, dividends, bull and bear markets, and portfolio diversification. Remember, knowledge is power. Keep learning, keep exploring, and never stop asking questions. The world of investing is vast and exciting. With a solid understanding of the basics, you're well on your way to becoming a savvy investor.